So hi y'all. I am Reba. I am the marketing and sales lead for Good Agriculture. So we want to thank you for joining us. This is our third webinar in our winter webinar series, where we've just been giving farmers financial tips, especially for you to plan in the off season. So thank you for being here. We know that it's been a long day, so we appreciate you being here. And I'll let you know a little bit about Good Agriculture before we jump in. And as Alan is pulling up the slides, I'll just let you know that Good Agriculture, we help farmers really understand the business side of things. So what we do, of course, is we focus on your money, your records, and your paperwork, just so you know where your farm stands. We know that, you all have to deal with a lot, and especially with wearing so many hats, our goal is to make sure that we can save you some time, and that way you can understand where your farm stands every month. So we do that by helping you with monthly bookkeeping, along with our monthly reports. And of course, now we're offering tax filing for our farmers. So of course, my job is to really help you figure out what works for you. And of course, I'll let Alan jump in and introduce himself.
All right. Hey, everybody. My name is Alan Osorio. I'm the Farm Finance Lead at Good Agriculture. I've been on this team for almost 3 years now, helping design our bookkeeping systems and supporting our farmers and helping them get on track and really gain that financial insight and clarity into their farming business. And so, I'll be mostly kind of running this webinar today. But we also have our other team member, Euna Joe, here. And so, I can pass on to Euna to introduce herself as well.
Hello, everyone. My name is Euna Joe. I'm a CPA from Good Agriculture. I'm helping farmers with the bookkeeping and tax returns these days. It's nice to meet you all, and please let me know if you need any help from us. And Reba, do you want to talk about some ground rules?
Yeah. So like I said, it's my job to explain what we do, answer any questions, and help you figure out what makes sense. So during this webinar, we want you to drop down any questions you have there. You don't have to wait until the end. If you do have a question in there that we're going to dive into, Alan will let you know. And then, of course, we'll answer your question during that time too. Also, we know that there are questions that are unique to your farm. So please feel free to give any specific examples or ask any questions there. We like to tell our farmers and I tell our team there is no such thing as a dumb question. So we want to be able to answer any questions that you have there. And, Alan has some great questions in there too. So we're going to ask you to also drop in the chat. So our goal, like I said, this is our third webinar in our winter webinar series. Our first one was with farm bookkeeping basics that Alan will wrap up and talk about and recap. And then also we did a preparing your farm for tax season webinar. So in the meantime, I'll also drop those recordings in the chat. So if you do want to look at it after the fact, you can go ahead and check it out. And then, of course, like if you have any questions on how we help our farmers, we are running a special going on where there is $200 off of either getting started with us or that one-time cleanup for tax season. And if you are interested, feel free to go to goodagriculture.com/start, or you can text over START to 470-318-3097. Thanks, and I'll toss it back over to you, Alan, for the recap.
All right, sounds good. And actually, let's see, there's actually an icebreaker first. So just to kind of get everybody warmed up. So if you guys just want to put in the chat here, if you had $1 million, but you had to spend it all within 24 hours, what would you do?
Okay, and as we are waiting to see, we want to, of course, test out the chat feature. If I had $1 million, I guess I'll jump in first. I would probably buy a lot of land, try to get as much land as possible.
Yeah, I don't think you can beat that answer, and it looks like that's what the chat is saying as well. I agree. Yeah, I'm trying to buy land for sure.
Sweet.
Yeah, I'll buy a farm too.
Perfect.
Yep.
And yeah, everyone is agreeing. And then we have another one where it's land and equipment. So mixing it up a little bit.
All right. Yeah, we have a lot of consensus here. That's great. All right, cool. So let's just talk real briefly what we covered in the first bookkeeping webinar. So we talked about things like tracking your finances, ledgers versus spreadsheets versus getting up on a software like QuickBooks or Xero. Tips and tricks for organizing your financial data, setting up your chart of accounts. This is kind of the bulk of it, of just like, what does it actually look like to go in there and set up all these revenue, expenses, assets, liabilities, and equity, and then also just generally, how to do some monthly bookkeeping. So now, as you'll see, what we're kind of going to assume that a lot of that has been taken care of, and now we just want to start digging into, okay, what do these things actually mean? So here's our agenda. We did our introductions, and then here's just kind of the general layout of the kind of stuff that we're going to want to address. So one, we want to answer the question, is my farm profitable? And as I'm saying these, feel free to share kind of like which of these questions are most interesting to you today. So is my farm profitable? That's going to relate to the income statement and understanding that. What is making and losing money? Where does all my money go? A distinct question from profitability. That's going to be found on the cash flow statement. And then also, is my farm building wealth? So that's going to be where we're going to want to dig into the balance sheet and answer, and kind of another question there, is all this hard work worth it? And so then we're going to want to talk about, do I have a plan? So once we kind of understand the financial health and what these financial statements are saying, then how do we move forward? And then we'll kind of talk about some additional resources. So yeah, kind of like what I just said, would love to hear from all of you all. Yeah, what are some of your goals? Are you trying to analyze your profitability more? Are you trying to assess your cash flows? Are you trying to determine if your farm is generating wealth or what that even means? Do you want to determine how financially resilient your farm is, save time during tax season, or go into the bank, or anything else? Would love to hear kind of how everyone is feeling today and what they're hoping to gain out of a webinar like this. All right.
Okay, so Brooke said profitability.
Awesome. We will definitely touch on that. Yeah, anyone else?
Tammy said financially resilient.
Mm-hmm.
And then Kelly asked, how do I account for grant money received in my bookkeeping and what do I categorize it as?
That's a good question. We don't get into the nitty gritty of that, but there is a section where you'll see how that relates, and I can go kind of freestyle that answer a little bit for you once we get there.
Okay. And then Cody did say just making sure I don't mess up my taxes too bad when I file.
Okay. Mm-hmm.
And then I want to make sure that I'm doing what it takes to be compliant, and I would like to get more detailed with my bookkeeping to know data and by enterprise in our operation.
Okay, awesome.
Another one for analyzing the profitability and then also accessing cash flow. Good answers, really good answers.
Oh yeah, cool. Yeah, we should cover a good chunk of that, and then if at any point, and then we should have some time for Q&A at the end if the content did not exactly meet kind of some of the stuff you're looking for. So I guess we should go ahead and get into it here. So let's start with that first question. Is my farm profitable? All right. So in order to answer this question, we want to introduce the idea that profitability has layers. There's layers of profitability. So when someone asks, is my farm profitable? It sounds like answering a question. And in some instances, it may be. If you're pretty mature, you've got years of historical data, and you're like, yes, we're a profitable business, you can say yes. But if you're in the boat of someone who's just starting out, just starting the business, this question becomes kind of hard to answer. And it's not always so simple because there are different layers of this profit. And this is what we will dig into now. Because all of these will tell different things about what's happening on your farm. So if you remember from the last webinar, we talked about setting up your chart accounts properly. This is where the hard work of organizing all those accounts starts paying off, because now you can actually read your income statement and understand what it's telling you, and you should not go through that process overly hastily. You really want to sit down and say, what are these accounts that are going to help me track exactly what is happening, and that they're categorized in their appropriate, COGS versus operating expenses and all that good stuff, which again, we talked about last time. So let's talk about these three layers: gross profit, operating profit, and net profit. And we'll see how each one kind of answers a slightly different question. So let's start off with just, the top of the income statement. This is kind of an area that doesn't need much explanation, which is sales. Everyone knows sales. That's the part that we all get, very excited about. So we won't spend too much time there. But how do we calculate gross profit? So let's start with cost of goods sold, or COGS. So COGS measures the direct costs directly tied to producing what you sell. And so this is going to include those material costs, direct labor, anything that directly goes into producing your product. So if you didn't produce anything, in other words, if there's nothing to be sold, then these costs actually just would not exist. And so examples of COGS, and these should look very familiar to you, is going to be those seeds and plants, fertilizer, feed, of course, depending on what you're raising, livestock purchase, processing costs, and then again, that direct labor. So you may also hear that COGS are called direct costs, and that's because they directly go into what you're producing. Sometimes a better name for those, this can be a better name, direct costs, for those who are on a strictly cash basis. I'm not going to open kind of the can of worms of accrual versus cash today, because that actually opens up a next level of complexity. But direct costs kind of makes more sense, because sometimes, when you're doing your bookkeeping, you're putting it straight to the cost of goods sold section, regardless of whether or not you sold product. Whereas cost of goods sold, there's that past participle there, sold. And so, yeah, just wanted to make that quick distinction. And then some people might also call these variable costs. And this is a pretty good name because they usually increase as production increases. There'll be some cases where that may not happen, but for the most part, that's kind of what defines COGS. It's directly correlated with sales. And so some people may like that term because of that nature of it, kind of correlating. And so let's see here, moving on to, let's define gross profit. So it is a very simple equation. So gross profit equals revenue minus COGS, so all those direct costs. And this tells us whether producing your product is financially viable. And so here are some answers, it helps answer some of these types of questions. So, are my products priced correctly? Are my production costs under control? Is this enterprise worth expanding? And so strong gross profit gives you the green light to scale. And if your products generate healthy gross margin, you can increase production to generate enough to cover your operating expenses, which we'll look at here in a little bit. If gross profit is weak, scaling is not going to fix this problem. It just scales the loss. It makes the loss that much worse. And so by its very definition, if you do not have a gross profit, you could almost argue that this business is just is not possible. It's because the more you try to ramp it up, the worse it actually gets. And so these are kind of the key elements of gross profitability. If there's no gross profit, then there's no use in, you kind of gonna go back to the drawing board and see what's going on, where either my costs are so too high or my prices are just not sustainable. So now let's move one step further down the income statement, which is going to be our operating profit. So gross profit told us whether the product works. That's kind of a really simplistic way to think about gross profit. Does the product or service work? Operating profit tells us whether gross profit is enough to cover the farm's overhead. And so let's define what these operating expenses are, which, some like to sometimes call OPEX. We like all these shorthand terms. So operating expenses are the costs required to run the farm business overall. So they are not directly tied to producing one more specific unit, kind of like COGS is. There's that correlation. Operating expenses don't have that. These costs generally exist whether you produce 100 units or whether you produce 1,000 units. Now, there may be, again, kind of similar to how some COGS may be fixed, but most of them are variable. This is kind of true here for operating expenses. Like most of them will be generally fixed, but there may be, you might take on a new salaried person, which will have a big bump in your operating expenses. And that just means that you're just going to have to then, assuming your gross profit margin is good, you need to scale up to then cover that increase in operating expenses. But it's not tied in that kind of direct correlation kind of way. And so some examples, these again should look like very familiar types of expenses. This is going to be your payroll. This is for most people, this is going to be like the biggest one. And this can also be not specifically tied to the production. So this is like more like your sales, general and administrative types of costs, people that are just helping run the back office of the business and things like that. Your contract labor, your car and truck, repairs and maintenance, supplies, utilities, insurance, all these things, they should generally be fixed. And again, yes, they may change. And it's good to kind of look for, where you can cut costs here, but that's kind of what helps define these types of expenses.
And Alan, we have a
Mm-hmm.
question
Sure.
where we ask, what is the difference between COGS labor and payroll and contract labor?
Sure. Yeah. So COGS labor is going to be, think of it this way, if that person was not out there, let's say harvesting is like a good example, there you are dependent on that type of labor for that product to get into the hands of consumers. That is not the same as, your marketing person who is generally, maybe they even are more remote, they work in an office, they're crushing it, they're doing a lot of good stuff to just kind of get the brand out there, and all that. And so it affects sales in that way, but not in the sense that it has this kind of direct connection to the product that is being generated. So hopefully that makes sense, and you can kind of think through other examples where that might be the case, like a farm hand. That one can kind of blur the lines for a lot of people, because if they're a salaried farm hand, are they still, that would be a good example of what you might want to consider COGS, but it is a little bit fixed because it's not necessarily like an hourly rate or, something like that. So it can get a little tricky, but that's a general principle that I think you could follow. So hopefully that helps. Were there any other questions?
No.
All right. So yeah, as I was kind of mentioning here, similar to COGS, how the people kind of threw out other names, we just kind of want to make you familiarized, and just, a lot of these terms may be kind of interchangeable. So like for operating expenses, for example, you probably would have heard overhead a lot. It's a very kind of common shorthand way. It's less of a mouthful than operating expenses, so I think that's why people like to say it. Indirect costs is kind of what other people like to say. And then again, in contrast to variable, some people like to say fixed costs. And so again, it's not that entities are inherently more correct or less correct. There's just kind of standard language that is used in the finance world. And these are just some words that end up getting used. But yeah, so let's define now operating profits. So operating profit is also pretty simple equation. You take the gross profit So we're not talking about revenue anymore, but that's already baked in. So gross profit was revenue minus COGS. Now we take gross profit minus the operating expenses. So this shows whether the gross profit generated from production is sufficient to cover overhead costs. And so depending on and this is kind of maybe a little rabbit trail too, so stick with me here, but I do think it'll help clarify some stuff. So depending on how you structure your chart of accounts, operating profit may also be referred to as this very kind of jargony word called EBITDA. It's an acronym, EIB, TDA, and it stands for earnings before interest, taxes, depreciation, and amortization. So in plain language, EBITDA shows how the farm is performing from the operations before you consider, debt payments, the interest of the debt payments, taxes, and non-cash depreciation. And so it isolates how the farm business itself is doing. And so another kind of quick note on this, many software systems like QuickBooks or Xero, they might lump a lot of these together, and that's technically fine if you're just trying to be compliant. And so the reason why I'm kind of taking the time to make this distinction is that it's more professional and more useful in decision making to structure your income statement so that interest, taxes, depreciation sit below that operating line. That way you can clearly see how the operation is performing separate from those items, interest, debt, and so on. So this separation helps you answer a more precise question. Let me see here. Yeah, there you go. So earnings before interest, taxes, depreciation, and amortization. And so this separation helps you answer more precise questions. So do current production levels support the business structure? Is overhead too high? Is the farm model working independent of how it's financed? So these are the kind of things that you're going to start wanting to think about. And here are some things that operating profit does not necessarily tell us. So it doesn't tell us, again, whether debt payments are manageable, whether taxes are covered, whether the owner is being paid, or whether the farm is building wealth. It's hinting, it may hint at some of that stuff, but we're not quite there yet. These two layers, gross profit and operating profit, we are just solely focused on. Let's zoom in, hyper focus in on, is this operation viable and is it on track to be profitable and successful? So I guess just a quick question for you all here, just based off of what we discussed so far, and I know we're only 2 layers in, so you might say you're setting me up for a trick question, aren't you? But I just want to hear from you all. Is this farm profitable, kind of given what we've discussed? And again, there's 2 types of profit. So I'm just curious to kind of hear y'all's perspectives based off of the performance of this example here.
Okay, we're going to give them a few moments. So we have an answer so far saying yes, and then there was another, it says another inquiry would be that we would need to look at increasing production in this example.
Yeah. Who said that?
Patricia.
Yeah. Yeah, that's great. So yeah, in a manner of speaking, are they profitable? Well, yes, in the sense of it looks like the product is working. They're generating revenue, their the direct costs are controlled, giving them a 53% gross margin. And now they have all these overhead expenses. And so, yes, that's exactly right. Now you're at this decision point of how do we ramp this up so that this deficit of 18,000 roughly dollars, we can start covering that and then get into a further level of profitability. So this is very common, in growing farms. So often overhead increases before production scales enough to support it. So you shouldn't find this like a jarring thing immediately, especially first and second year, you're just getting started. It's all about your context. Let's see, you could also reduce. Yeah, exactly. So you're kind of at this decision point of like, well, let's evaluate all these operating expenses. Are these all actually foundational to the structure of the business or not? So yeah, operating profit. Let's see, not to go too far. Yeah. So operating profit helps you ask again, like it was mentioned in the chat, do I need to grow production? Do I need to reduce overhead? Or do I need to improve, pricing or production efficiency of some kind? And that the production efficiency side, we'll talk a little bit about as well, because that's kind of where you get into investments and improvements and all that kind of stuff, which maybe a quick pop quiz. Does anyone know if that kind of stuff shows up on the income statement or not? Maybe a little trick question, but anyways, that was me and that wasn't scheduled. All right, so now we've reached this final layer of profitability. So gross profit, again, told us whether the product works. Operating tells us if gross profit can cover overhead. So it's kind of letting you know where are you in terms of scale. But net profit now tells us what's left once we include financing decisions, interest, capital investments, but not the purchase of those investments themselves, but through depreciation, and then taxes and other non-business income like grants and government payments. So let's talk about interest, which is the cost of borrowed money in the most simplest definition. So financing is very common for farm, especially during growth and startup phases. And excuse me, loans allow you to purchase land, equipment, livestock, infrastructure before you've earned the cash to do so, right? So you might be in that position, kind of like we were just looking at, where gross profit looks pretty good, net operating profit not so good, but you've kind of maybe gone through that hard work and analysis of knowing what that may look like in the future, and so therefore you kind of make that argument to a lender and you get some funding to then really start making some bigger improvements and decisions there. So that can be a smart growth strategy, but over time, ideally, you want to see that leverage decrease, because you want to depend more on the equity being generated by the farm to accomplish those things that you want to do. So as debt is paid down, interest expense declines, and more of the farm's earnings build equity instead of going to the lenders. And so kind of the takeaway here is what the net profit, in between operating and net, what it allows you to see is the cost of that leverage. And so this becomes especially insightful when you have more financial data and you can kind of compare over time. So similarly, depreciation is in this kind of interesting situation where it's this thing that is what you might call a non-cash expense. So depreciation, what is it? It spreads the cost of your capitalized assets over time. So if you buy a tractor, you don't treat it as a 1-year expense. You spread that cost over its useful life. And what net profit allows you to do is to see how that cost is being spread out, even though the cash did not necessarily move in that period. And so that might get a little confusing because, and this is where I'm kind of alluding to the importance of the cash flow statement, which is what we're going to want to touch on here in a moment. And so this equation, again, a very simple one, just maybe a little few more details. It equals the operating profit. And by the way, so I think there's actually a little typo here. That second layer is supposed to say total other income. Apologies for that. So this equation is just as simple. It's operating profits plus or minus these additional other expenses or income. And so we kind of net those in its own line and net other, income/expenses, and then we add that to the operating profit to finally get net profit. And so what does it tell us after production costs, overhead, financing, capital investments, taxes? Is there still a profit? And this is why a lot of people call this the bottom line, because at this point we really have gone through all the different layers of profitability, and yeah, there's no more layers to go. So just to kind of look at this example a little more, so I kind of put the operating profit back up on the screen here. Remember, the farm had an operating loss of negative 18,000. If you include those other expenses, even though it's not calculated explicitly, it brings the profit down to roughly negative 50,000. But then after including that grant income, which is around 50K here, the final net profit is slightly positive, but really this is basically break even. And so that raises an important question. Is the farm net profitable because the core business works? And I guess I'd be curious just to hear from the chat here.
Okay. And as the answers are coming in, Alan, we did get another question for you. So the question is it an option to deduct it all at once instead of spreading it out?
So it is an option, and that's that's where you kind of get into a distinction between kind of tax strategy and financial reality. So what we're focusing on today is going to be more on that kind of the financial reality of depreciation. Like I was saying earlier, you might take advantage of that kind of accelerated depreciation. Now, does that mean that all of a sudden that, let's say, call it a tractor, that all of a sudden it has no resale value in the real marketplace? Well, of course not. You know, it's purely a tax strategy thing, and so that's distinct from doing this analysis for, yeah, just more kind of concrete financial reasons. So so yeah, and I don't know, Una, if you have anything else to add onto that, or if I.
Yeah, the tax wise, you can expense it whole in 1 year, especially in 2025. They passed the like a law, One Big Beautiful Big Act, and you can use a bonus depreciation for 100% expense it, or the like a fixed asset like tractor or big items you purchase in 2025.
Thanks, Una. And we'll also drop the link. We spoke about the One Big Beautiful Bill and what that really means for farmers' taxes and cash flow. Alan, to answer the question on is the farm net profitable because the core business works? We got a couple of answers.
Okay.
So not yet, unless you depend on
Mhm.
future grants and government payments. And then another one was, I don't think it's net profitable without the grants.
Yeah. Yeah, so I think those are really good answers. I like not yet. That's kind of like a nice way to put it. So at the moment, yeah, it's kind of like no, the core business, the operating profit is negative. And then on top of that, there was these other interest into depreciation and taxes, which brought it down even further. The grant is really what brought it out of that hole. And so yeah, and I guess I'll take a quick moment here. Someone asked about grants earlier. There are kind of different methods you can use to earmark, those expenses that are, grants should be for certain things, et cetera. So one kind of overly simplistic way that I have seen people successfully use is to actually just create one account that kind of is also below that operating line, just dedicated to those grant related expenses. And then you just got to make sure that your vendors and everything on your bookkeeping software is very detailed, because what you're losing is some of the detail of what category it goes to. That's kind of the con of that. But the pro is that it's all in one place. And so ideally, like let's just take 50,000 for example, and it was earmarked for $50,000 of different types of expenses. You would want to see one be positive 50, one be negative 50, and that would give you that peace of mind that you've been kind of appropriately stewarding those funds to exactly where they need to go. The other method would say, well, I do want, the things I'm spending on to go exactly where they are, And so then at that point, you can kind of use either tagging or class features. You just got to be careful with that, because if you're already using classes for, things like profit and loss by enterprise, which we'll, talk about a little bit at the end here, you don't want to overuse classes for multiple dimensions of data. And what I mean by that is, if I like to give the livestock example, if you're tracking beef, pork, and poultry, um, something could be related to that grant, but also related to one of those enterprises. And then you're kind of forced to choose which class you want to put it in. And that's where something like a tag could be a little bit better. However, actually, I need to confirm this. I think QuickBooks specifically is getting rid of that feature. Anyways, that I think there are like some accounts still have it, some don't. So that's kind of in a weird territory. But just wanted to answer that question real quick.
And
Cool. Is there any other questions or?
we did. So Una, we have a question for you. So how would you determine the value of a tractor that was gifted or refurbished?
Um, Actually, there's a way of doing it. It could be, I will just say it really simply, that if it's a gifted, there's two way of doing it. You can do like carry over basis. You need to know how much they pay for a for example, tractor when they purchased it, and then minus depreciation they took, and that's the base of a carryover base for your tractor. Or if the fair market value is lower than carryover base from the prior owner, then you need to take the fair market value. And that's the two way of doing it. And for republished tractor wise, just example, you need to know how much it costs, like to repair it. That you sum up all those costs for your cost basis.
Thank you, Una. And then we have one more question where do you have to pay off the asset before you can take the whole cost of the asset as an expense in that year?
Sorry, could you read that one more time? Or let me see if I can pull it up.
Yeah, I can read it one more time. Do you have to pay off the asset before you can take the whole cost off as an expense in that year?
I guess it sounds like there's a question of like if this is a piece of financed equipment is kind of what I'm hearing in that. And I guess this will be just a very kind of general answer. And I'll probably want to keep going after this just so that we don't spend too much time on these kind of slightly more tax related questions. But um, yeah, generally, regardless of whether it's financed or paid outright, it's still something that gets capitalized, goes on the balance sheet, and there will just be some nuances as to, how the liability shows up versus if you paid in cash, there will be no liability. But regardless, it's still an asset that you kind of have to make a decision about how it's going to be depreciated, generally speaking. Um, but yeah, and I have actually one more question here before we move on to this next section, because this is a kind of good segue. So is this net profit the amount that increases the bank account number? Really curious to see the responses to this one here.
Okay, the answers are rolling in. So far, everyone's saying no.
Okay. All right. So net profit is not the same as cash in the bank. It's not the number that is going to move the bank account number. And this is something that is always, I find, kind of gets people confused. This crowd seems to really understand that is not the case. So I'm very impressed by that. But why? So a few reasons why, just even in this example. So depreciation, again, it's non-cash. So it's not actually cash leaving your account today or in this period. Similarly, loan principal payments don't show up here. This is just the interest portion. And then again, kind of like we were just talking about, large equipment purchases don't show here in full either. And so net profit starts to help you answer questions like, is this farm financially viable? Is there money to reinvest? Can I pay myself? Is equity growing? But regardless of all that, it's still not the answering the question of where did all the money go. So before we get there, let me just do like a little quick recap. So is my farm profitable? To answer this question, here are some kind of general things you got to understand. What are my direct production costs? Are my products priced high enough to generate margin? Is gross profit enough to cover overhead? How do financing, capital investments, and taxes affect the bottom line? And so it has layers, you know, it's not always a simple yes or no. And we just got to be able to dig into all of these things. So for example, you can be profitable at the gross level, but not the operating level. It's like the example we saw. You can be at an operating loss today, but on track to cover overhead as you scale. That's a very nuanced answer. You may be net profitable because of grants, but yet not yet self-sustaining, like we saw, or you may be financing heavily now with the expectation of stronger profitability later. So let's get into this question now. So where does all my money go? So let's shift from thinking about profitability to cash. So just like profitability is not always simple yes or no, cash can kind of be that way too, just because there's different aspects of cash flow that we need to understand. So to understand it, we have to understand that there are these different types of cash movement inside a farm. The cash flow statement answers a different question in the income statement. And so profit tells us if the business works, but cash flow tells us what actually happened to the money. And as a kind of like just a quick note here, I think that the cash flow statement gets a little bit less attention. It gets a little underestimated. The income statement, the balance sheet are kind of always the financial statements. They're the ones that they get all the shine. But the cash flow statement, I like to call it almost like the glue or the channel between those two, actually. And so it's a very important statement to understand. And when you understand it, you actually stop guessing about where the money went. You don't have this frustration about that. And so, yeah, let's get into these three types of cash flow. So we have operating, investing, financing, and then finally net cash, which, as you'll see, is just a sum of those three. You'll also notice, just another quick side note, it's very kind of delightful how a lot of these things are broken into kind of three big chunks. That's true of all the statements. So if you're coming into this thinking financial statements are confusing, I don't really get them, just remember they are actually broken down into pretty digestible little chunks, and it's just a matter of sticking with them and really understanding what each portion is. So let's look at operating activity. This section answers a very specific question. How much cash did the farm actually generate from running the business? It's arguably the most confusing part of the cash flow statement, I will say up front. So let's see if we can maybe dig in here a little bit. So notice where it starts. It actually starts with something that should look very familiar from what we were just looking at, the net profit amount. That number is actually in this section of the statement. And so the cash flow statement connects directly back to the income statement. But we don't just stop at net profit because profit is not the same as cash. So from there, we kind of adjust two main things. I mean, arguably, as the things get more complex, there might be more than two. These are kind of the biggest two that affect cash from operating activity. So first is going to be what you might call non-cash items. And the most common version of this, as we've kind of talked about, is depreciation. So it reduces profit, but no cash actually left your bank account. Remember, you bought that thing last year, in this example, and there's no money movement happening this year. So even though we're spreading out the cost, just to understand how that big purchase affected profitability for the cash flow purposes, we got to add it back. Almost feels like a little bonus. It's kind of nice. And so this is one of the clearest examples of why profit and cash are different. And I think for a lot of people, if they were confused, this starts kind of turning the light bulbs on and being like, okay, yeah, that makes sense. That $10,000, even though it was in my income statement, it didn't actually occur. I didn't look at my bank statement and see that. So let's add it back. And so that's an example of a non-cash. So second is going to be timing differences. And this is mostly going to be your accounts receivable and accounts payable. I'll make a quick side note for anyone here who's kind of exclusively direct to consumer kind of a business, don't let your eyes glaze over at this portion, because I know that maybe for you this is not as relevant if you're working more at like farmers markets or e-commerce where there is no waiting period between, receiving money. But I think it's still important to understand these concepts, especially if you end up developing a more wholesale side of your business or whatever. So, but if you are already doing that, this is going to be a very extremely important concept to understand regarding, cash flow and understanding how to, time things effectively. So you can be profitable on paper and still be waiting, 30, 60 days. And I mean, hopefully not 60, but, you can be waiting a few weeks before that cash actually hits your bank account. So with that being said, what is accounts receivable? Well, it represents the money you've earned but not collected yet. And so, and most people understand that. What is maybe less clear is what is this negative number here? What is negative 21,000? So what this is doing is it's adjusting for sales that occurred during that period, but you just haven't received it yet. So the income statement is showing $21,000 of sales, but because you haven't received it yet, you have to adjust for that so that you don't kind of inflate your net cash amount. And so this is going to be a very important thing. And similarly for accounts payable, it's these bills that you've received, but you haven't paid them yet. And so as payables increase, it means that you kept cash in the bank a little bit longer, even though you'll, pay it, the next week or next month or whatever it is. But for the specific period that you pull this cash flow statement, it's just basically saying there was bills incurred, but they were not paid yet. So, and either of these can go either direction, and they would just mean the inverse. So looking at kind of everything, so what is happening here? We have these like four numbers, and then they're all adding up to this 5,390. So net profit was only 578, but after adjusting for depreciation and timing differences, the farm actually generated this larger number. It's a pretty meaningful amount. And so this should already be a clear indicator as to why net profit is not the number that moves the bank balance, which seems like all of y'all kind of know that, but hopefully it gives a little bit of more substance as to why. Looking at the investing activity now, let's kind of jump into that. And I think this is actually a little more straightforward, but there's a few confusing things that I'll be curious to see how people kind of interpret this. So this section answers a different question, which is how much cash should we use to build or improve the farm? So investing activity includes cash used for, long-term assets. So this can be things like machinery and equipment, tractors, infrastructure, land, buildings. And so they're not the same as, these day-to-day expenses. These are investments in the farm's productive capacity. And so now notice something important here. These numbers are red, but don't be too scared by that. So do you remember when I was kind of saying cash flow statement is the glue between income statement and the balance sheet? These negative numbers actually correlate to positive numbers on your balance sheet. Why? Because when you buy equipment or improve infrastructure, even though your cash goes down, cash is an asset, but then these fixed assets go up. So you're swapping one asset for another. And so it's really just a conversion of cash into something valuable. So yes, that's why investing activity is not the same as an expense. And these purchases don't hit the income statement all at once. Instead, they show up on the balance sheet, like we've talked about there, the spread over time, depreciation. So in this example, the farm spent $48,000 in this period on capital investments. And that is a large cash outflow, and that will affect how you make decisions, especially if you're getting into that, forecasting and planning and okay, yeah, I think I'm going to have to make this big purchase at such and such time. You got to plan for that. But just remember, these are kind of adding to the overall net worth when you make these investments. And so you shouldn't think of it as a loss in the classic sense in the same way that you would think about like that negative 18,000 that we were looking at before. And so over time, things should look, here are some things that you should look out for. after making investments. Did these investments lead to a material improvement in operating activity? Did revenue increase? Did efficiency improve? If not, that's definitely a signal worth paying attention to. You'll see when we talk about some ratios, that'll be relevant there. And so now we can ask, how is this investment funded? Was this investment funded by operations or by financing? So let's look at that real quick. So financing activity, pretty straightforward. How's the farm funded? Financing activity includes the cash received from or paid to lenders and owners. So this is a matter of liabilities and equity. Both of those types of movements are showing up in this financing activity. So in this example, the farm received $21,000 from a tractor loan. So they actually financed the tractor. $200,000 from an operating loan, and the owner took out $25,000 out of the business. And so let's talk about first these liabilities. So the cash flow statement shows loan principal movements, not interest. And so remember, interest appears on the income statement. Principal appears here because it directly affects the loan balance, and that's the key. So like think if you're going through your bookkeeping process and you see that loan payment and you're going to categorize it, remember to split that interest and principal, because if not, you're kind of it's going to show that you're paying off this debt faster than the schedule, which is not accurate, and it's not going to let you clearly see what that cost of borrowing is. So those are two very important factors to understand: is how fast am I reducing my debt, and how much is it costing to take on this debt. Those are going to be extremely important things that you don't want to conflate. For the equity side, so for most, I would assume from most of the attendees here, it's going to be more about owner and partner contributions and draws. And so, owner draws, they do not show up on the income statement either. They're not expense, but they do, reduce cash, like in this example here. And so this section makes it easy to see whether you are meeting your personal draw goals or whether your business is supporting your household needs. And I also make a side note that in some business structures, a little bit beyond today's scope, but equity could also be things like common stock, investor contributions, things. This goes into a more legal structured discussion, which is beyond today's scope. I just wanted to highlight that that there are other types of equity that could exist. But yeah, so for most farms, I think it'll be owner partner contributions and draws. But financing activity, it simply makes the funding visible, right? So it shows clearly how the farm is supported through either debt or through owner or partner decisions. And so each section of this cash flow statement tells a part of the story. And so let's put them together now to see how they interact. So net cash simply tells us, did cash increase or decrease over this period? In other words, this is the amount that moves the bank balance number, right? So you should be able to put an opening balance, and maybe you have two bank accounts connected to your accounting software. It should be, the sum of all the cash that you had plus all this activity or minus should equal that ending balance. This is that true number. So profit alone, again, does not do that, but the net cash does show you where that is. And so in this example, the farm generated cash from operations a little bit, so not a lot. They kind of broke even. It raised cash through financing quite a bit, and it used cash to invest in equipment and infrastructure. And when all that was combined, cash increased by this kind of roughly $150,000. And again, I just want to highlight this tractor again specifically. So if the tractor had been paid in cash, you would see a 21,000 drop in overall net cash activity. Cash would have gone down by that 21,000. But because it was financed with a loan, the 21,000 came in under financing activity, making it a net zero impact on cash at the time of the purchase. So over time, as those principal payments are made, remember, split the interest out, you'll see cash leave under financing activity to repay that loan. And that's going to be really important. Again, when you start looking at month over month or week over week, types of financial statements, you want to be able to see how that kind of stuff is moving. And so this highlights, that other difference is that when it is financed or when it is cash, it's simple to record. The transaction happens, it's on the bank statement, just record it. You have a new asset and you converted cash to the asset. But if it is financed, there's more steps. I think we talked about this a little bit in the previous webinar if you want more details, but remember that you got to put in those proper journal entries to record the asset, the liability, track the future principal payments correctly. And that structure really matters if you want clean financial statements that are not confusing and really give you an understanding of what's happening. So the cash statement pulls all this important information together, and it shows clearly how the bank balance moved. And so once you really dig into these and understand them, you should be able to trace every single dollar and not have any questions. So I guess I'll pause there. I didn't have any real direct questions in that section. I just kind of wanted to get through it, but maybe I could pause now just to see if anyone has cash flow statement related questions before we dig into the rest of this here. But if not, we can just keep moving. All right, so is my farm building wealth? So balance sheet, I like to call it a snapshot of the farm's financial position. It's pretty unique, a unique financial statement in the sense that it's kind of the only one that's not dependent on a range of time. It is cumulative. It's adding up everything from the past. And it looks like there was a question that came in. Let's see. Where does the loan payment and interest show up? Expenses. Yeah, so the loan payment is going to be, of course, one transaction. You send it to the financing institution. It is your job or your bookkeeper's job to be able to look at the loan schedule or the statement that they send you. Hopefully it's clear. I've seen about 50 statements at this point, and some of them are not clear. So I'm sorry if you work with a lender who's a little bit just messy with their statements, but they should have that clear split. And simply you would code the interest to the interest account, which shows up on the income statement, and then the principal portion to the actual loan account in your books so that it can reduce the balance. All right, so moving now from activity and period of time to just a snapshot in time. So the balance sheet shows us where the farm stands in a point in time. So this statement answers a few questions here. So what does the farm own? What does the farm owe? And then what is left for the owners or partners in this business, which is the equity. So unlike the income statement, which resets each year, like I said, this balance sheet is cumulative and it reflects everything that has happened over time. So every profit, every loan taken, every asset purchased, every draw, all of it cumulatively shows up in the balance sheet. And the balance sheet has three main sections. Again, going to those, there's always three sections, which is nice. So assets, what the farm owns, liabilities, what it owes, and equity, what belongs to the owner after the liabilities are subtracted from the assets. And so this is where we can start answering this question of, is the farm building wealth? So starting with assets, these are the resources the farm owns that have economic value. We've kind of talked about assets a good amount at this point. So one thing that I would like to highlight that's a little bit, hopefully a little bit more insightful about how assets are structured on a balance sheet is that the most liquid assets are closer to the top, the less liquid are towards the bottom. Now, what does liquid mean? So this is going to be anything that is easy to turn into cash, basically. So cash would be kind of considered the most liquid. I mean, it is cash, so that's why it's, basically the most liquid. And then you might see like accounts receivables next step because it will turn into cash soon. And then you have, inventory, this is a finished good that you have that, once it's sold, it's going to become cash. And so these will be more of our current assets. And then as you move down the balance sheet, you have your fixed assets. And there are intermediate as well. We can get into that here, but generally you can think of it as kind of a progression. So fixed assets are going to be the stuff that are harder to turn into cash. So this is going to be like your tractors, vehicles, infrastructure. You can imagine, I mean, how do you sell infrastructure improvements? So you would have to kind of sell your whole business. And so this helps you quickly assess the financial flexibility. So they tell us more than just what we own. They kind of see how flexible we are. So you can kind of imagine if someone has a lot of liquid assets but very little fixed assets, or the inverse, you start kind of thinking about through the implications of that, and it can kind of give you a little bit of insight as to where they're at in their business. Liabilities, the things that the farm owes. So again, this connects directly back to the cash flow statement. This is where all that principal activity, money borrowed or money repaid, the balance sheet shows what remains after the activity. So like, for example, this loan from individual, like where did this come from? This was not on the cash flow statement. And so that implies that there was a loan that existed maybe a couple years prior, maybe some payments were made, but in this period, because we saw it didn't show up on the cash flow statement, it was not affected at all, but it still is a balance. It's still something that you owe that you're going to want to keep mind of. So cash flow, it shows the principal payments over time, but the balance sheet, shows that remaining balance. Let's see here. So the same applies to the tracked loan and the operating loan. Cash flows explains what changes here. The balance sheet carries it forward. So yeah, pretty straightforward, I think. Just kind of, you got to remember that cumulative nature of the balance sheet. It's taking, again, a lot of that cash flow stuff is mostly showing up here with, a few other things, but yeah, so it's also similar here in the structure in how the current liabilities are kind of the things that are owed the soonest versus things that are owed later on. So that's kind of another pattern here that you should be familiar with, and also helps kind of explain that flexibility as well. So on the equity side, this is a pretty this is what's left after the liabilities are subtracted from the assets. So assets minus liabilities equals equity. And so it basically represents the owner's claim on the farm. And so you have your contributions, your draws, your net income, your retained earnings. All of this builds or reduces equity over time, just like the rest of the balance sheet. This is cumulative. So retained earnings is kind of a interesting one because and I think it can also trip a few people up, but it's basically a cumulative number of past years' profitability. So this is interesting in this example. How they have a retained earnings of $35,000, but today's or this year's net income is only break even. So that makes you wonder, I wonder what went into that. Why have they kind of been a little bit more profitable in the past, but now all of a sudden their net income is looking a little bit more slim? That's where you can start maybe saying, oh, well, maybe there's a likelihood that they did make that jump up in operating expenses, and all of a sudden they're taking that hit. And now there is a pressure to say, let's take all these investments and let's scale our production up, so that the next year we'll have a much greater profit, and then our retained earnings will grow by that same amount. So hopefully I know we kind of went through the balance sheet a little bit more quickly. I wanted to spend more time on the income and the cash flow statement, but we're not technically totally done with the balance sheet, because now we can kind of start talking about some ratios. So let's see here. So a current ratio, very simple equation: current assets divided by current liabilities. And what is this really telling us? So this ratio answers a very practical question. If everything due in the next year had to be paid, could the farm cover it? So in our example, the ratio is actually extremely high. That actually would give me maybe a little bit of red flags and just want to dig into the books and say, okay, is this actually that high? But that means that current assets are almost 14 times larger than their current liabilities, and that would be like extremely strong. Um, in fact, there's almost no reason why they just wouldn't go ahead and pay off all these liabilities immediately. And so some benchmarks matter here, generally between 1.5 and 3 could be considered healthy. Below 1 can indicate some pressure. Very, very high numbers mean strong liquidity, but they can also suggest kind of idleness, like just not deploying your cash effectively and just kind of holding onto it. And so that's also why that could be, kind of a red flag to see a recurrent ratio that's a little bit too high. Like, how are you actually using these funds? And so kind of at its core, current ratio tells us about short-term stability. So this ratio helps us kind of one piece of this wealth building question, which is the farm stable in the short term? Because that is a very important question. How are you going to build wealth if you're going to crash and burn next month? So that's something that you're going to really want to understand. Debt to equity ratio, it measures your financial leverage. So it compares your total liabilities to your total equity. So in some simple terms, for every dollar the owner truly owns the farm, how many dollars are now financed by debt? And so using this example, we come out with a ratio of 5.9. So that means that for every $1 of equity, there's about $5.90 of debt supporting the business. So that's what that would be considered, quite a bit of leverage. And we saw that big loan that came in the cash flow statement. And so let's kind of maybe think about this more practically. So imagine next year, the farm ramps up production, which at this point we've kind of figured that this is what's going on. If it generates real operating profit without relying on grant income, let's say it earns $40,000 in net income, that profit increases equity. And so if equity rises from, this number that it was on the balance sheet, roughly 40,000 and it doubles, so like 80,000. And at the same time, let's say all that equity that they're generating, they're using to pay down some of that debt, let's say like $30,000 of principal or something like that. And then there's a lot of math that happens here, and I know that it's not visually happening. So, but basically 1 year could really vastly improve this debt to equity ratio by bringing it from like 5.9 down to 2.6, simply from, really ramping up production, maybe finding that you can be a little more aggressive on debt pay down and really kind of improve that figure. So yeah, I think this ratio really matters. It shows whether the farm is gradually becoming more owner-owned over time. So not just stable, not just liquid, but just kind of like on a very foundational level, it's structurally stronger. And that's also part of this wealth building question. So if liquidity kind of tells us more about like survivability and stability, then this leverage tells us how much we own versus how much we owe. And both of these are going to be extremely important. So now return on assets, also a pretty simple formula. So take your net income and divide it by the total assets on the farm. And so this ratio answers this question. For every dollar of assets the farm controls, how much profit is it producing? So in this example, again, net profit was pretty small, so it's going to be rough. So $578 divided by 281,000, this equals 0.2%. That's very low. Now, so this means that the farm generated only about 20 cents of profit for every $100 of assets. And this is interesting though, because this farm has strong liquidity, has a lot of cash. It also has high leverage. A lot of that cash came from debt. And so, but it has a very low asset return. And so you can start kind of putting the puzzle pieces together. It's stable in the short term, but it has built some assets. The assets are not yet generating strong profit. And that kind of reminds me of someone's answer before. That's why I really liked, not yet, because is this ratio pretty kind of not great in this exact moment in time? Yes. But it doesn't take into account kind of what is planned to happen later on. So if you measure this over time, you can kind of showcase how you've improved your return on assets. So some benchmarks here for small business, 3 to 8%, below 1%, kind of like this example. It's not meaningful return yet, which can be common if you're in early growth, capital heavy. And so, yeah, it really lets you see, was it worth investing in these assets? And it kind of can give you either confidence or maybe rework and think, okay, did we invest in the right things, and help you make some better decisions there in terms of building wealth. So is my farm building wealth? It depends on kind of these three main. It's not only these three things, of course, but here's just some three for you to kind of chew on. So short-term stability. This is going to be kind of your current ratio. Can you cover those short-term obligations? Long-term structure and leverage. It's going to be that debt to equity ratio. How much is currently owned versus financed with debt, and then just the performance. So are the investments in your assets generating meaningful profit? And so, yeah, this wealth builds when all three of these things are improving over time. All right, so that covers the financial statements. I think for the sake of time, and this part is a little shorter anyway, so we just want to briefly talk about now kind of what it looks like for planning. So budgeting and forecast. We've talked a lot about kind of analyzing what already happened. And at some point, it's like kind of baby steps. You start with basic bookkeeping. You just sign up for the software. You connect your bank account. You create a chart of accounts. And that felt like an arduous task. Understanding the statements feels like this, okay, I really got to understand these things so that I can make meaning out of it. Kind of going beyond that now is going to be wanting to look forward, which is really hard because, as the common saying goes, like, we don't have a crystal ball. Like, we can't just magically know what's going to happen. So there's some kind of tips here to start thinking about how to do that. So a budget. A budget is set at the beginning of the period. It reflects what you intend to make happen. Basically, it's the key question here is, what are we planning to make happen? And this is distinct from a forecast, where the key question is, given what happened, where are we headed? And so this is going to be really important to get a grasp on and really distinguish between these two things, because a budget is something you kind of want to set, and then a forecast is something that, as time goes on, you get updated data. You can be like, okay, how, was our budget accurate? And then, so the budget, you typically don't want to adjust it too much, but as you do more forecasting, you can kind of start making adjustments. And so you don't want to be reactionary. You want to plan, use numbers to guide your decisions. So how do you even get estimates for budgets? You can look at your historical data if you have some. This is obviously not possible if you're just starting. Quotes, call around, look at vendors, suppliers, talk to other farmers, university extensions, search engines, LLMs even, that could be helpful to at least get, things spinning. So just some ideas there. Budget versus actuals. This is just kind of like a quick example of what this report may end up looking like. So you have your budget, and then you import your actual financial data. You look at the variance, and then you compare that over time. So like in this example, maybe January looks scary. Oh, we're way under our goals. But then February kind of overshot it. March stabilized. And then by the time you compare, an entire quarter, you realize, maybe we've kind of underperformed on gross. Maybe we've actually done a little bit better with operating. And so overall, this kind of gives us some insight into how we can get into some projections and forecasting. And so again, this is super detailed. This is kind of a thing, a webinar in and of itself, because it can get so complex. But basically, in a nutshell, what you're going to want to do is, take the historical data. You're going to want to set up, different drivers and all these key assumptions, and be able to come up with a robust way to say, okay, what can potentially happen 3 months from now, 6 months from now, 12 months from now, and to be able to input, key cash flows that you expect to occur. Kind of the really important thing here is to have a projected closing balance. This is going to really help you see, am I going to be tight on cash? What do I need to do? What do I need to adjust? And that's kind of where you get to that next level. And so speaking of just kind of next level stuff, again, just for the sake of time, we're going to kind of just breeze through these real quick. But always feel free, reach out to us, ask more questions if you want maybe some more in-depth answers to some of this stuff. So profit and loss by enterprise, kind of going back to the income statement again, once you've actually learned how all that, to structure all of that, you can really start to flex it. So instead of looking at just the whole farm, you can start breaking it down by, the different activities in your business. And then, yeah, this is where you can start analyzing which one have stronger gross margins, which absorb more of the overhead, which, produce stronger operating profit. And yeah, this can be extremely insightful, but it's highly dependent on you having good systems in place. And so just some general tips here, set up classes or tracking categories for each enterprise. Again, don't mix data fields. Don't combine sales channels and product lines in the classes, because then you're going to say, which one do I put it to? That's kind of the biggest mistake I see. People end up with 20 classes, all different things. Now choose 3, 4, or 5 main classes, and then be consistent with it on your bookkeeping process. Come up with a sustainable system to regularly track your expenses. So understand your vendors, keep track of your invoices, receipts, and for big purchases, be able to go in there and split that detail up. And that's going to make a really big difference in the accuracy. Also, set up your sales platforms with a very clean structure. Many times I've seen, whether you're, kind of on a POS system like Square or Toast, even, there's kind of all these different platforms, or even e-commerce ones like Shopify, or ag-specific ones like Local Line, Braze Car, Barn to Door. I've seen a lot of these where the SKUs or the products are not set up in such a way where it makes it easy to track the sales very well. And so you end up going through all this work on the expense side, but then the sales side is messy and you end up with no insight. So you got to make sure you really dedicate some time up front to make sure that this is all really in check. It's just some general kind of tips on how to split cost by enterprise. So you can do like a direct allocation. That's probably the most important one, because this is where you're able to really see that receipt, that vendor, understand where's it going. If you can nail that one at the very least, you're going to be good. When stuff is blurrier, you have a few options. You can do an allocation by volume. You could also do like a percent by revenue. And this is going to, help, maybe spread out some things. But that direct allocation is going to be kind of the most important part of making sure that you're understanding your costs. Few notes here on unit profitability. Won't get too much into this, but this is also going to be a really important part of kind of analyzing how all your different products are doing. This is also kind of the stepping stone to, what I was kind of alluding to earlier of like accrual COGS, basically, accruing all your expenses on your balance sheet. And then as things are actually sold, you have, a good methodology for saying, well, we sold X number of SKU number 1, SKU number 2, because we've done this analysis based off of actual costs. We know that this is the cost for each SKU. And then you have a really nice and tight profit and loss statement that's not just dumping all your COGS immediately onto the P&L. So that's going to be really important to be able to kind of like do that unit profitability analysis, kind of like you can see here, like a profit per head. So yeah, that kind of brings us to the main ending here. So hopefully, we were able to learn how to analyze profitability, income statements, assess these cash flows, understand your balance sheet and how to generate wealth, kind of maybe spark some usefulness of how to actually interpret ratios. And so, yeah, I thank you all for joining this time. I think we want to try to fit in a Q&A if there is time, but if not, maybe Rita, I'll let you kind of decide. where we should head next.
Okay. So we did get a comment in there, Alan. And I want to make sure that we get Robert's comment in there about balance sheets. And he said that the balance sheet shows no principal payments that were made during the year on the tractor loan, nor on the farm loan. So then he says that it seems like the recording the balance sheet is not as helpful as actually making payments.
I see. So I think I think what you're seeing here is a balance sheet. Let me see if I can pull that up real quick. Where, yeah, here you go. What you're looking at here is actually a balance sheet where there's kind of this brand new loan that showed up. So the payments actually in this specific scenario, you can assume that they have not been, billed to make a payment at all yet. But what you would expect over time is to, yeah, see that getting reduced. And so, yeah, I hope that kind of helps clarify, or I hope I understood your question correctly. But yeah, the assumption here is that no payments have been made, if that's helpful. Okay, yeah. Oh yeah, and then again, just other tools and resources real quick. Uh, Accounting software, of course, get set up on that if you haven't. Get all these things set up. Also, we do bookkeeping, and I can kind of let Hariba explain some more of that.
Yeah. So just to let you all know, we do help our farmers when it comes to really getting that balance sheet together. As Alan explained, we also help with cash flow statements. And just depending on how much insight your farm needs, we're able to help you out. So we say that our farmers really join on three different buckets. One being basics. So that is if you just want us to handle the books for you. And, we clean up any bank activity you have there, keeping things organized, and then sending you those financial reports every month, just so you get it. Um, but we know that there are some farmers that may need some more in-depth insights. And we like to say that that's where Essentials really jumps in there. So on top of the bookkeeping, we actually customize those chart of accounts that Alan showed you before, just based on your farm. And then we give you monthly snapshots so you can see what's making or losing money. And then of course, you meet monthly, at least 30 minutes a month with the team. You have the option to kind of walk through those numbers. Finally, we have the premium tier. So that's for, we like to say the entrepreneurial farms, where you're looking to get a deeper understanding of your business because you're looking to either plan ahead or scale. So with that, as Alan showed you an example before, we can break down profitability by that enterprise there, help you plan out with your cash flow projections, and then also run through any like what if scenarios there. We also customize those reports a bit more just because we know that with that, you may need a little bit more in-depth insights, whether it's for investors or it's to go and get a grant. So we do specialize that for you. And then you have the option to meet with the team, and of course you get priority support because we know that you need more in-depth insights. Outside of that, when you join us with monthly bookkeeping, we also do help out with filing taxes for our bookkeeping farmers. So that starts at about $400. And of course, what we can do is talk with you. So if you do have any questions for us or you want to know how to get started, Alan, do you want to click over a couple of slides?
Yeah, sorry.
Two more. And you can click over one more. Then you can always feel free to text us. You'll see in the bottom right-hand corner, we have it where you can just text webinar to our number, and then we'll also drop it in the chat. But like we said, we will send over a recording of this webinar for you so you can check it out. And then outside of this recording, we'll also send over an example of a sheet that you can use there, just so that way you'll be able to see the example for like the balance sheet there that Alan was talking about, and you can kind of plug in your numbers there as well. But we do thank you all for joining us tonight. We know that, of course, you had a long day. So if you have any questions, please feel free to let us know. And of course, what we can do is if you have any questions that go beyond the webinar, I can always shoot that on over to the team too, to Alan and Una. So thank you all and have a great night.
Thank you.